Friends, imagine this, a company that, in just 20 years, went from a wild Silicon Valley idea to joining the ranks of the global tech Magnificent Seven, with its stock price soaring hundreds of times. It doesn't sell software or smartphones, it sells heavy asset cars. Yet it has four-century-old automakers into the role of followers. Yes, that company is Tesla. So, who exactly is Tesla? It's long ceased to be just a car company. If we rewind a decade or so, Tesla was merely a bold dream born in Silicon Valley. Its ambition was simple yet utterly insane: to use a beautiful electric sports car to disrupt an entrenched, century-old gasoline empire. At the time, nearly every industry giant scoffed at it, dismissing it as yet another Silicon Valley bubble bound to burst. But Tesla and its celebrity spokesman and CEO Elon Musk turned that dream into reality. Not only did they survive, but with products like the Model S and Model 3, they became a ferocious catfish that completely shook up the global auto industry. Tesla redefined what people thought an electric vehicle could be: not a compromise, but a perfect fusion of performance, intelligence, and sustainability. Tesla single-handedly cultivated the massive EV market, and for years it captured most of the profits in it. In doing so, Tesla became the world's most valuable car company and briefly made Musk the richest man alive. It forced legacy automakers to pivot in a panic, rolling out their own electrification strategies, spawning countless Tesla killers, most of which have already faded into obscurity. It's a textbook case of disruptive innovation. But the story is far from over. Today, Tesla stands at a strategic crossroads. No longer content to be the Apple of the auto industry, Musk envisioned something far grander: to make Tesla the world's leading sustainable energy company and a pioneer in AI and robotics. What does that mean? It means Tesla is performing an extremely difficult balancing act. Its left leg must stay firmly in the present, fighting in the bloody red ocean of the car market, generating continuous cash flow to feed the entire group. Its right leg, meanwhile, is stepping boldly into the future, pouring huge sums into full self-driving, FSD, humanoid robots, Optimus, and other seemingly sci-fi fields whose payoffs may be distant but whose potential is enormous. This wanting both sides strategy has made its latest earnings report look almost schizophrenic, and market opinion about Tesla more divided than ever. Is it a mature, top-tier automaker, or still a tech startup burning cash for a faraway dream? Hello everyone, I'm your wealth strategist, Daryl Hart, with 25 years of market experience. I know that after Tesla's latest earnings release this month, two camps have been at each other's throats. One is the Musk believers who think he's building an interplanetary civilization. The other is the Wall Street accountant, calculators in hand, yelling about valuation bubbles. So today, let's sit down and dissect Tesla's Q3 2025 earnings report like a precision machine. Let's see what the numbers say and what they don't. First, let's admit it, this report does feel a little schizophrenic. Not in a negative sense, more in the way it reflects Tesla's internal tug-of-war between present and future. Let's start with a fireside that made the bulls ecstatic. Revenue hit $28.1 billion, up 12% year over year, crushing expectations of $26.36 billion. This was mainly driven by record vehicle deliveries and energy deployments. Free cash flow surged to $3.99 billion, up 46% year over year, far above the expected $1.25 billion. That's the single brightest number this quarter, largely thanks to Tesla clearing out excess inventory from the first half of the year and releasing $2.1 billion in working capital. Now for the ICE side, profitability plunged. Gross margin fell to 18%, down from 19.8% a year ago, though slightly above the expected 17.2%. Excluding regulatory credits, gross margin was only 15.4%, down from 17.1% last year and below the forecast of 16.3%. This clearly shows that discounts, tariffs, and the lower margins on new models are continuing to erode core profitability. Operating income dropped to $1.62 billion, a 40% decline year over year, missing expectations of $1.65 billion. Adjusted EPS came in at 50 cents, below the expected 54 cents and last year's 72 cents. Regulatory credit revenue fell to $417 million, the lowest in 2 years, and management guided for further declines. That means one of Tesla's easy profit sources is drying up. Traditional analysts will push up their glasses and say, "See? Profitability is collapsing. The business model is flawed." But not so fast. The story isn't that simple. I think this looks more like a strategic choice. Tesla seems to be deliberately sacrificing short-term profit for greater market share and cash flow. It's like a restaurant choosing between fine dining and a fast food chain, and Tesla's clearly chosen the latter. It's as if Tesla is printing money with one hand while throwing part of it into a furnace called the future. Everyone's debating whether that furnace is smelting gold or just cooking a very expensive stew. From the stock's trajectory, one thing's clear: Tesla's golden growth phase as an automaker is flattening out. This quarter's stellar numbers partly reflect a rush buying wave before US EV tax credits expire, a one-time boost that pulls demand forward and can't last. More importantly, competition in the car market is now cutthroat. Giants like GM, Ford, and newcomers like Rivian are all fighting aggressively. Tesla's been forced to use price cuts as its weapon of choice, directly eating into margins. Policy tailwinds are fading. Regulatory credit revenue has cratered to $417 million, the lowest in 2 years. What used to be free money is nearly gone. Tesla now has to earn everything the hard way. On top of that, tariffs and heavy R&D spending are putting further pressure on profits. So, just selling cars alone won't recreate the old days of soaring profits and volume. Tesla's auto business is evolving from a growth story full of imagination into a more mature, slower-growing value play, with even a touch of cyclical stock behavior. Now, if the story ended there, Tesla would simply be a great automaker. But its valuation remains high because investors are still paying for the story beyond cars. This quarter, its energy and storage revenue grew 44% year-over-year, far outpacing the car business. That second growth curve, especially in large-scale energy storage, shows massive potential. And that brings us to the three grand narratives Musk himself has painted for Tesla's future. We all know about full self-driving, FSD, and Robotaxi. These are the foundations of Tesla's valuation story. If successful, Tesla would transform from a hardware seller into a service-based mobility platform, a complete revaluation of the company. Then there's the humanoid robot Optimus, a story even bigger than the global car market itself. But robots are also money-eating beasts, far from turning a profit anytime soon. And the Dojo supercomputer, the engine that powers all these AI dreams, requires astronomical levels of capital spending. Here lies the key issue. The fuel for these grand dreams comes from Tesla's auto-generated cash flow. Now that the fuel's growth is slowing while the dream's burn rate accelerates, the mismatch between the two is Tesla's biggest risk and its biggest source of intrigue for the future. Over the next quarter, Tesla has 3 episodes coming up, and the outcome of each could impact the stock more than the current earnings. The first is like a drama film, Tesla's Corporate AI and Future Strategy Conference. The market no longer wants flashy PowerPoints. It wants concrete timelines for Robotaxi and Optimus, deployment details, and regulatory progress. Any tangible updates could dramatically shift sentiment. The second is like a thriller, November's shareholder vote on Musk's compensation package. It's essentially a trust referendum. Approval means shareholders are still betting on his long-term vision. Rejection could trigger major uncertainty or distract Musk himself. It's a high-stakes gamble that could define Tesla's future direction. The third is a slice-of-life episode, Tesla's Q4 delivery guidance. The market currently expects around 370,000 units, a cautious estimate. If Musk raises guidance to something like 450,000, it would signal that even while burning cash on the future, Tesla still controls its present fundamentals. Right now, the Wall Street debate over Tesla has turned philosophical. The believers say investing in Tesla is investing in the future, in AI and robotics. They care about FSD adoption rates and Optimus progress, not short-term margin swings. The realists counter that fundamentals matter until they don't. They warn, if auto profits keep shrinking, where will the cash come from to feed those expensive AI dreams? Neither side is absolutely right. It's all about time horizons. They're simply pricing different timelines. When dealing with a company that embodies both the gritty reality of a legacy automaker and the futuristic ambition of an AI giant, we need a clear strategy to handle its volatility. My advice: abandon faith, embrace strategy. Treat Tesla as a satellite speculative position, acknowledge its volatility, and set strict stop losses. If it breaks the line, cut it without hesitation. View it as a venture capital style bet: small potential loss, massive potential upside. At the same time, exploit market sentiment swings. Tesla's volatility provides ample short-term trading opportunities. For instance, even after this earnings dip, bulls haven't fully capitulated, creating setups for rebound plays. If you want to hold Tesla as a core long-term position, you must have unwavering faith in its AI vision and be prepared for wild swings and potentially years of waiting. Stop worrying about quarterly margin fluctuations. Focus instead on the true drivers of its long-term future. How deep is FSD adoption? How many cities have Robotaxi operations? How large is the fleet? Is the energy storage business still growing at high speed? Those are the metrics that tell you whether Tesla is evolving from an automaker into an AI powerhouse. But regardless of your strategy, remember these two golden rules. Burn them into your mind. First, because of its high-risk nature, Tesla should only ever be the seasoning in your portfolio, not the main dish. Never bet all your money or worse leverage on one of Musk's dreams. Diversification is non-negotiable. Second, Tesla's biggest risk is that the future story remains unfinished while its car-selling cash engine starts to sputter. Keep a close eye on free cash flow, whether it can still sustain that AI money furnace. Friends, Tesla is no longer a simple company. It's a complex organism in strategic transformation, part world-class automaker and energy business, part expensive AI research lab. Its Q3 2025 report tells us this. The current core remains solid, though thinner in margin, while the future dreams are growing ever costlier and hungrier for funding. For investors, the key question isn't about next quarter's delivery numbers. It's this: when you buy Tesla, are you buying a steady cash-generating automaker or an expensive lottery ticket for an AI and robotics future? Your answer determines how you dance with it. Over the next 3 months, as these three blockbusters hit the stage, new twists and stock volatility are inevitable. Buckle up and enjoy the ride. If you're feeling lost in today's market storm, or if this analysis has given you new clarity, subscribe to this channel and hit the bell icon. Every week, I'll bring you deep insights into the latest macro events, actionable wealth strategies, and guidance on everything from asset allocation to risk management. I'm Daryl Hart. See you next time. Invest wisely and stay rational on your journey forward.